Hey there, fellow market watchers. Hope you had a good Tuesday. Things just got really interesting on Wall Street. We're recording this right after the closing bell, and the NASDAQ,
Yeah.
it decided to party like it's 1999
Yeah.
and hit another record high. But before you break out the champagne, remember what's lurking just around the corner. Tech earnings, the election, and the Fed meeting. Talk about a potential market hangover.
It's definitely a cocktail of uncertainty brewing out there. Lots of ingredients that could shake things up.
Exactly. So think of this deep dive as your market survival guide for the week. We'll break down what's moving the markets, what signals you should be watching for, and what it all means for your portfolio. So first up, let's talk tech. Specifically semiconductors. They were absolutely on fire today. The PHLX Semiconductor Index, you know SOX, jumped a solid 2.3% to reach a two-week high.
What's fascinating here is that this surge is likely fueled by something we've been talking about a lot: AI. Investors are betting big on strong earnings reports from tech giants, especially when it comes to the demand for AI chips. It's like everyone's suddenly realizing, hey, AI is not just hype, it's actually driving real profits.
And speaking of those tech giants, get ready for a wild ride this week. We've got a lineup of heavy hitters reporting earnings. Alphabet and AMD already stepped up to the plate today. Tomorrow it's Microsoft and Meta. And then to finish the week off with a bang, we have Amazon and Apple on Thursday, so buckle up.
It's going to be a busy week for sure, and a potentially volatile one, depending on what these companies have to say about their AI strategies and their outlook for the rest of the year.
Well, speaking of Alphabet, they didn't waste any time making headlines after the bell. Their shares popped up over 4% in after-hours trading. They absolutely smashed earnings and revenue forecasts. It's like they hit a grand slam.
And it's not just the overall numbers that are impressive. If we dig a little deeper, we see that their Google Cloud revenue soared a whopping 35% year over year. That means Google Cloud is becoming a serious contender, going head-to-head with the likes of Amazon and Microsoft. And then there's the advertising side of things. Google ad revenue climbed by 10.4%, and YouTube ad revenue wasn't far behind with a 12.2% year-over-year increase. They brought in $88.27 billion in revenue, way above what Wall Street analysts were expecting.
So it sounds like AI is paying off big time for Alphabet.
It definitely seems to be a key driver of their success, and this brings up an important question for all of us. As these other tech giants report their earnings this week, pay close attention to what they say about AI. How are they integrating it into their business models? What's their return on investment? And what are their thoughts on the regulatory landscape? Those are the details that could really move the market, especially for those of us who are interested in individual stocks.
Great point. Now here's where things get a little more complicated, maybe even a bit unsettling. While tech is having its moment in the sun, the broader market isn't exactly joining the party. It's kind of like watching your favorite team win the championship, but then realizing you left your car keys at the stadium.
Exactly. We're seeing mixed signals out there. For instance, the 10-year Treasury note yield hit a new 3-month high today, climbing above 4.3%. Now, this might sound like a bunch of financial jargon, but think of it this way. Imagine you're lending money to the government for 10 years. The interest you'd get on that loan just hit a 3-month high. Why? Well, it's likely due to some surprisingly strong economic data we got today. Investors see a strong economy and think, maybe inflation's going to stick around. That makes them demand higher interest rates on their loans, including those they make to the government.
Okay, that makes sense. So strong economic data is actually pushing interest rates higher, but isn't that a good thing?
It can be, but it also introduces uncertainty. Higher interest rates can make it more expensive for companies to borrow money and invest, which could slow down economic growth. And then there's the whole election thing. We can't forget about that. Pre-election positioning. Basically, investors adjusting their portfolios based on who they think might win is also likely playing a role in these mixed signals.
Right, the election feels like everyone's holding their breath to see how that's going to shake things up.
And then we've got the Fed meeting coming up next week. All those factors combined explain why the broader market seems a bit stuck, like it can't quite decide which way to go. The S&P 500 is hovering between its 20-day moving average, which is just above 5,800, and those recent highs we saw around 5,870. It's like it's caught in a tug of war between optimism and anxiety.
So not everyone's riding the tech wave, huh? Let's take a look at some individual stocks that took a hit today. D.R. Horton, the home builder, had a rough day, dropping over 7%. What happened there?
Well, they missed earnings estimates, which always makes investors nervous. But what really spooked them was D.R. Horton's disappointing 2025 home delivery forecast. They're basically saying they don't expect to build and sell as many homes as Wall Street was hoping for. And this isn't just bad news for D.R. Horton. Other homebuilder stocks followed suit. dropping in sympathy.
Well, that doesn't sound good for the housing market. Is this a sign that higher interest rates are already starting to bite?
It could be higher rates make mortgages more expensive, which could cool down demand for new homes. And speaking of companies feeling the pressure from higher costs, Ford also had a rough day. Their stock plummeted more than 8%, and this is despite the fact that their earnings and revenue actually beat analysts' estimates.
Wait, what? Their earnings were good and their stock still tanked? That doesn't make sense.
Well, here's the thing. Ford also lowered their 2024 profit outlook, citing pricing pressures. Basically, they're saying that it's costing them more to make their cars, and they're not sure they can raise prices enough to make up for it. That spooked investors, who worry that Ford's profits might shrink in the coming year.
Ah, so it's all about managing expectations. Even if you have good news today, a bleak outlook for tomorrow can overshadow it. And then there's PayPal, which lost almost 4% because they missed revenue forecasts. Not a great day for them either.
Nope, not at all. It seems like even in a market where tech is booming, not everyone's a winner. That's the stock market for you. Always full of surprises. But hey, it's not all doom and gloom out there. Remember AMD, one of the chip makers we talked about earlier. They surged nearly 4% in pre-market trading. Investors are clearly excited to see their earnings report tomorrow and find out if they're keeping pace with the AI boom. And other chip stocks like Broadcom and Supermicro Computer also saw solid gains today.
Okay, so there's still a lot of enthusiasm around semiconductors. Makes sense given how much buzz there is about AI. It's like the Wild West out there, with everyone trying to stake their claim in this new frontier. But let's shift gears a bit and talk about the bigger picture. What kind of economic data should we be keeping an eye on this week?
Well, we got some interesting news from the job market today. The September Job Openings and Labor Turnover Survey, or JOLTS for those who like acronyms, revealed that job openings dropped to a 3-year low, coming in at 7.443 million. That's significantly lower than the 8 million that analysts were expecting.
So fewer job openings. Does that mean the job market is weakening? Is this the beginning of the economic slowdown everyone's been whispering about?
Not necessarily. Here's where it gets interesting. The quit rate, which measures the percentage of employees voluntarily leaving their jobs, also fell below 2% for the first time since 2020. And we also saw an increase in layoffs. So what we might be seeing here is a normalization of the job market rather than a dramatic decline. It's like things are settling down after a period of intense activity.
So instead of a sudden crash, it's more of a gentle easing. That's good news, right?
It could be. A more balanced job market can actually be a healthy thing. It can help to keep wage growth in check and prevent inflation from spiraling out of control. But speaking of inflation, let's talk about consumer confidence. The Conference Board's Consumer Confidence Index for October significantly surpassed expectations, jumping to 108.3 from September's 99.2. That's the biggest monthly increase we've seen in 3 years.
Wow, that's a big jump. So despite all the uncertainty we've been talking about, consumers are feeling pretty good about the economy.
It seems that way. Growing confidence can often lead to increased consumer spending, which is good news for businesses and the overall economy. But there's a catch. The report also showed that inflation expectations are rising. Consumers are starting to worry that prices might continue to climb.
So it's a bit of a mixed bag. Consumers are feeling confident, but inflation is still looming in the background. It's like trying to enjoy a picnic while keeping an eye on the storm clouds gathering on the horizon. So what other economic data should we be watching for this week?
Well, on Thursday, we have the Personal Consumption Expenditures Price Index report. This is the Fed's preferred inflation gauge, so it's a big one. And then on Friday, we get the October non-farm payrolls report, which will give us more insight into the health of the job market.
Okay, so lots of important economic data coming our way this week. Make sure to mark your calendars, folks. But before we wrap up, let's zoom out a bit and look at the global scene. What's happening in the rest of the world that could impact our markets?
Good point. There are a few interesting developments worth mentioning. First, there are reports that China is considering issuing a massive $1.4 trillion in extra debt to try to stimulate their economy, which has been slowing down lately.
Wow, $1.4 trillion. That's a lot of debt. What about Japan? Any news from the Bank of Japan?
They have a rate decision coming up on Thursday. Most analysts expect them to keep interest rates unchanged for now, so no big surprises anticipated there.
All right, so Japan's probably staying the course. What about oil prices? They've been pretty volatile lately, haven't they?
They have. Crude oil prices actually fell below $67 per barrel today. This is partly due to easing tensions in the Middle East. But here's something to keep an eye on. One key price level to watch is the September 10 closing low of $66.31 for WTI crude oil futures. No front-month crude contract has closed below that level since late 2021. just before the war in Ukraine began.
So if oil prices fall below that level, it could be a sign that the global economy is really slowing down.
Potentially. It could also signal that demand for oil is weakening. Lower crude oil prices are typically good news for consumers and businesses that rely heavily on transportation, like airlines and trucking companies. For instance, the Dow Jones Transportation Average is up more than 1% so far this week and 6% since the end of the second quarter.
Interesting. So lower oil prices could help offset some of the inflationary pressures we've been talking about. But then again, we've got the Fed meeting coming up next week. What
Yeah.
are the chances they'll cut rates again?
As of today, traders are predicting an almost 100% chance that the Fed will cut rates by 25 basis points at their meeting next week. We'll have to wait and see if their predictions are accurate, but a rate cut could signal that the Fed is concerned about the economy slowing down and is willing to act to support growth.
So to recap, we've got a mixed bag of signals. Tech is booming, but the broader market is hesitant. Economic data is giving us glimpses of both strength and weakness. The global economy is facing its own set of challenges, and the Fed is likely to cut rates again, which could either boost the market or add to the uncertainty.
It definitely feels like we're standing at a crossroads. Lots of different paths the market could take from here.
Exactly. It's like we're in the eye of the storm with those tech earnings, the election,
Yeah.
and the Fed meeting all swirling around us. So with all this in mind, what are some key takeaways for those of us who are trying to navigate this market and maybe even make some smart investment decisions?
Well, I think the biggest takeaway is that we're in a period of transition. The old rules of the market might not apply anymore. We're seeing a shift in leadership with tech, especially AI-focused companies, taking center stage. But that doesn't mean other sectors are out of the game. It just means we need to pay attention to the underlying trends driving those sectors.
So it's not just about chasing the latest hot stock. It's about understanding the bigger forces at play, kind of like being a detective, looking for clues to figure out where the market's head next.
Exactly. And speaking of clues, I'd encourage everyone to pay close attention to the economic data we talked about. The JOLT-S report, the Consumer Confidence Index, the PCC Price Index, the Non-Farm Payrolls Report. These are all pieces of the puzzle that can help us understand the health of the economy and where things might be headed.
So don't just check the stock tickers. Check the economic indicators too. They can give you valuable insights into what's driving the market. Any other advice for our fellow investors as they navigate this volatile landscape?
Remember that investing is a marathon, not a sprint. Don't get caught up in the day-to-day fluctuations. Instead, focus on your long-term goals and make sure your portfolio is aligned with those goals.
Solid advice. And speaking of long-term goals, it's worth remembering that even in uncertain times, the market tends to reward those who stay informed, stay disciplined, and stay focused on the fundamentals.
Absolutely. And remember, there's always more to learn. Keep digging deeper, keep asking questions, and never stop exploring. That's how you stay ahead of the curve.
Well said. With the NASDAQ at record highs and a wave of economic data and events on the horizon, what signals are you paying closest attention to as you navigate the stock market? Food for thought as we wrap up this deep dive. Until next time.